Good morning. This is Pat O'Mara. I am with Inveniam Capital Partners, and I'm here with some of my coworkers and some fantastic guests who are going to be talking about the need for price discovery as real world assets go online, and what does that mean? And how do we find price discovery in the digital asset era, not only to understand that under the underlying asset and the state of that asset, but to understand it at a frequency which has historically not been demanded. And so there's a whole lot of things that are going to happen as these digital assets for real digital assets are trading that represent interests in real world assets. And it's just really an exciting group that we've got here. And so if we can, Michael, we're going to start with you. Would you give us a quick introduction of yourself and what you do?
Sure. Thank you, Pat. I'm Michael So, Head of Deal Execution and Tokenization at Oasis Pro Markets. We are a broker-dealer and also a technology-focused tokenization agent. Thank you very much.
Hey, buddy, it's great to have you. John, we're going to go to you, my friend. Thanks for joining us again, coming from over in the Middle East. And Michael is in New Jersey. John is just down the street in Abu Dhabi. John, thanks for joining us.
You're welcome. Yeah, thank you for having me. So I'm John Nieman. I'm head of investments for a group called G42. We're basically a tech conglomerate here in Abu Dhabi. About roughly 30 years of private markets experience, places like State of Michigan Retirement System, State Street, Saudi Aramco, Adia, before joining G42. So nice to meet you all. Thank you.
John, it's great to have you, my friend. Adam, my brother, it's good to have you on this podcast. Normally I'm on yours. Adam, give us a quick introduction.
Yeah, thanks so much, Pat. So I have a couple things going on. One is I have a company called Interaxis where I have been, I used to be a financial advisor, used to have my own RIA, and I now teach crypto, DeFi, blockchain, AI, whatever's going to disrupt the future to other financial advisors. As you know, Pat, I'm also part of a multi-family office called Bespoke Group with a focus on new first generation wealth, crypto, tech, those levels of wealth. That's our focus based here in Colorado.
Adam, it's great to have you, buddy. You always provide enormous insight. Gabriel, you are in Miami, I think, at a conference, and so your camera is going to be going on and off as you work the room. Gabriel, give us a quick introduction of yourself.
Thank you, Pat. Pleasure to be here. Yeah, I'm at the Tokenize This conference in Miami, so I'll be switching on and off. But I'm the head of business development at DigiShares. DigiShares is a white label tokenization platform. We work mostly with real estate, but all sorts of real world asset developers and tokenizers. And we're launching in Q3 alongside our ATS partner Texture Capital, something called realestate.exchange, and we're very excited about it. It'll be a secondary venue for tokenized real estate shares.
Boy, it is so good to be with you. Klaus has been on this podcast a couple of times, and it's just great to have you here. David, thanks for being with us, my friend. Tell us a little bit about yourself.
Yeah, the quick answer is a long time of structured derivatives and then trading floor and trading business management. But at this point, I sit with Houlihan Lokey, which is a large publicly traded investment bank and is a specialist in private assets. I sit inside a business that does valuation, even as frequently as daily, to your point. And we're very excited to talk about where valuation becomes price discovery in the future.
Fantastic. That's awesome. Albert, great to be with you. I think people who've watched this podcast before know you, but give us the quick Albert intro.
Sure. So my name's Albert Verdellens. I lead the AI division at Inveniam. And in most rooms, I consider myself knowledgeable on real world assets and price discovery. But most of what I learned is from the individuals and firms represented on this podcast today. So I'm looking forward to being a student again.
Albert, great to have you, my friend. Julian, thanks for joining us. And Albert's in Miami natively. not traveling there as Gabriel is. And Julian is joining us from Singapore. You get the award for the late joining. Thank you again, my friend.
Yeah, thanks, Pat, and good to see everyone here, Michael and other speakers. Julian Kwan, co-founder, CEO of two RWA platforms. So InvestorX is licensed tokenization software as a service platform based out of Singapore, and IXSwap was we started about 3 years ago, and we wanted to build the first kind of automated market maker for real world asset tokens. So we call it the Uniswap for RWA. So it looks and feels like Uniswap, but it runs through broker-dealer securities license and has custody license, but essentially it was built so anyone with an RWA can start a liquidity pool. So excited to hear what everyone's got to say about liquidity here today, and thanks for having us on board.
Hey, absolutely, we really appreciate it. Kevin, it's always good to have you.
Yep, and title is Chief Data Scientist, but role is very often, as on this call, sort of how do we make people's data work better on the Inveniam platform? And sort of chief among them is that pricing data, especially when it's come from someone like Houlihan Lokey or Cushman at Wakefield, where it's a third-party mark on an asset. So that's what I do all day, and I'm, like Albert, still learning from everyone on this call.
It's so great to have everybody here, and as real world assets, which really we talk about those in two different ways, right? I'm here in Santa Monica, California today. I'm giving I think the keynote at the real world asset session of the Tokenize conference, and tomorrow I'll be with Gabriel and some others at the Tokenize This conference in Miami, giving a talk. But really talking about what is real world assets, and there's two different kind of buckets. When people talk about real world assets, where it is a representation of a traded security that has referenceable data in an Edgar database or in the EMMA database, right? So that is money market funds, treasuries, tokenized Apple shares that are just trading in a digital form. But then there's others that kind of is the focus of this, which is private market assets, illiquid assets, where first we have to perfect the information, right? And the data is not in a referenceable database, and we need a mechanism for that. And Inveniam, that's one of the problems that we're looking to solve, the primary one that we're trying to solve. And then from that, then with price discovery, there's illiquidity. And David, I'm going to turn that over to you, right? You guys are pricing a lot of private assets around the world. Where you guys are using our software in the Middle East to price a bunch of sovereign wealth fund assets as we speak. And this price discovery of real world assets or alternatives, in this case, private equity, that is being done. First, we're perfecting information. And then with that, there's a discount for lack of marketable information that goes away. But then that opens the door for understanding what is the illiquidity premium. You know what I mean? And how do we price that? And David, you really were targeting that and talking about that. Give us a little bit about that.
Well, when you think about the world of private market assets, one of the things that investors get paid for is this illiquidity. Your money's locked up. And we've never really had a good metric to measure that difference, except for whatever the public markets are versus the indices that get created out of private markets. And they're all very historical. So when you try to make these comparisons, it's all very backwards looking. One of the things that we're trying to do, and Inveniam is facilitating, is speeding up that process such that valuation becomes an element of price discovery. And if you do that by taking a process that used to take a month and you turned it into 3 minutes, granted may have a different accuracy level, but then you can start to assemble a large enough set of valued assets that you can get a real-time understanding of that liquidity premium. And I think that's going to vary quite a bit as those markets start to calibrate, and that calibration is in itself going to be an opportunity for investors.
Yeah, we're going to talk about this in a minute, particularly around real estate. There's a couple people who are going to talk about what's coming up. But Julian, you've been doing this, right? You've been creating pools, 6 or 7 pools of real world assets that are trading in a Uniswap, Sushi Swap fashion that literally are not trading at a discount. They're actually trading at a bit of a premium to their inherent value because of that liquidity, right? Talk to me a little bit about what you created and what you're experiencing in the market right now.
Yeah, good summary. So if you go back to 2017 to 2021, everyone was saying the real world asset security token space, the only value proposition was liquidity for liquid assets, but there was no liquidity. So we looked at cryptocurrency markets. If you go back to around that same time, 2017, 18, there was no liquidity on decentralized exchanges because there was no system built for it. So everyone traded on the big cryptocurrency exchanges where there were market makers. So the development of the automated market maker model, the AMM, came out, and it basically allowed anyone with a cryptocurrency to start a liquidity pool. Well, two sides, your cryptocurrency and the other cryptocurrency. And that was the birth of liquidity on the DEXs, the decentralized exchanges, and it was a zero to hero innovation. It was fast, it was cheap. Talking about price discovery, like there was no one pricing any of this. It was just what was it available on the exchange, what was someone willing to buy. So the difference with the AMM model versus the kind of the exchange, the centralized exchange model is the centralized exchange got the order book and the matching engine. You can see all the different orders, but on the AMM model, it's just buy token A, priced in token B, take it or leave it, right? So it was simplified. It was much dumbed down. So that's what IXSwap was. We thought all these real world assets, most are going to want trading. They're not going to belong on centralized exchanges. They're too small. They're too strange. No one knows about them. What if we see if we could take the innovations of DeFi and build it so it was legal compliant for a real world asset security token? So that's what IXSwap does. Anyone can bring a real world asset token in the pair, which could be USDC, it could be Ethereum, and they can fast, quickly, low cost set up their first liquidity pool, and it can be as small as $10,000. It does run through a broker dealer and a custody license, so it's a legal pool and a legal trade. So that's what sets it apart from Uniswap. And so I try to throw a whole 3-4 years of development into like 60 seconds to try to save everyone's time. So what happened is also we launched the first 7 or 8 pools, and it's been incredible. There've been small pools of bigger assets, and there's been debt tokens, and there's been equity tokens, and attached to solar panels and startups. There's been a secondary of a very large startup as well. And so
Julian?
I lost Julian.
I lost Julian too. And so I think podcast.
15x.
Hey, Julian, your internet disconnected. I'm going to just fill in for everybody, and you nod yes, okay. That's correct. But basically, you listed these 6 or 7. They began trading well, and some were trading at multiples of their book or their NAV, not at a discount, which is a great thing to see. And so what I would like to do, if we can, is thank you, Julian. That's truly innovative, right? And as we go in and we see pieces of the capital stack, a token that represents a capital stack of a real world asset, we need to understand what is the thing trading, what is the gross asset value of the underlying enterprise or asset, a building, a private equity concern, a stake in a fund, right? What is it holding? And then you need to run a waterfall and a carry calculation, and then you can price the capital stack, where you hold that instrument. What that does, a byproduct of that, is that's going to also start to reprice GPs, right? GP stakes are going to get repriced in there all the time, and that's going to create a huge opportunity, right? And so how we think about this and what's going to come and what's going to get better pricing, and how do we aggregate that liquidity so one order can't swing the market? You know what I mean? And your AMM function acts as that tool, right, to aggregate this. But John, I want to go to you, right? The ability for you to invest in a manager in the GP or into a fund, and then understand the GP's economic interest in that asset, right? Or the developer's carry, right, in that asset in real time. What does this do to the market's ability to invest when we can start to get real-time pricing on the asset more frequent? And what does that do at a future state? But not only, what do you want to see when this is when we're building this data?
That's a great question, multi-layered, and I'm trying to figure out which direction to run down. But I think the for me at least, the oldest example that I've seen of this applied is in music royalties. It's a little bit of a kind of a not widely talked about area in tokenization, but nonetheless, it's there. Spent a lot of time working with music royalties and content more broadly as I was building out the royalties allocation for Audia. I had done some things similar for Aramco, and so was deep into it. And music is a place where the closer you get to the insiders, the more of information asymmetry, the advantages with the buy and the sell and the value creation, et cetera. So it takes being on the inside and knowing which catalog to buy and what to do with that. That's ideal. And from an institutional perspective, that's what you would target. The second layer then is the more developed managers that have maybe a little more broad-based application, but still honed in on media and entertainment. And then you have, the larger, more generic managers, asset managers that manage hundreds of billions of dollars or trillions of dollars, and they're not seen as specialists, but yet, they cater to institutions and other constituents. What I saw with, and I don't know how to pronounce it, never have learned, but it's VEZT or VEZT to my European and Canadian friends. So I don't know. I say VEZT, but at any rate, that's a tokenized platform that basically allows an individual to be able to buy songs. And so you could buy $50 worth of, I don't know, Billy Idol White Wedding, for instance, and just for the sake of saying that you own a piece of this particular song, or for whatever reasons. Now, the step up in return profile or step down is quite intriguing to me, because at this VEZT layer, the individuals are getting probably around 6% type of yield plus return on that particular asset. Institutionally, let's say the large asset managers that are more broad-based would be around 10 to 12. Specialization, maybe 12 to 16. And then I would typically target, 16 plus, which is not bad for credit-like risk. So, when you ask about what are we looking for from an institutional perspective, I think it's multiple. First of all, how do we, as institutions, play in that to make sure there's a supply of assets that could be tokenized, and it could be in the form of a diversified, like think of an ETF or digital format like that, or down to the individual asset level. How does the institutional market play in that, where it's attractive for them, but also supplying so that, as Julian had commented, there's attractive things for investors to want to invest in, that they would participate a little more broadly and with higher volumes.
And John, do you mind if I jump in real quick? I want to I think what the institution wants to do is buy at the 16 return and lay it off at the 6, keep the B piece and do that. Michael and Gabriel and Julian want to take the 6% piece and move it to 8%. You know what I mean? And say, somewhere in the middle of that, the 6% yield buyer understands that there may be a B piece or an equity or a first loss piece that the majority of economics go to, right? And they're getting the first return piece. But the whole premise of what we're doing is trying to, normalize this where there is the information asymmetry is removed, right? And then the access asymmetry is removed. And let me give you one last comment there, and then I'm going to go to Michael. Did you want to add anything?
No, and that's exactly that's exactly it. Is in terms of the ability to fractionalize, be able to have more people participate, and in terms of adding value, absolutely. I've seen scenarios where people are rewarded and they will pay up because you think about an average, not ultra high net worth, but an average high net worth portfolio or the average investor portfolio, retail investor. How do they get access to real world assets unless it's tokenized? It's very nascent and absent in their portfolios unless they go through a REIT, which it's interesting the comments that I heard earlier that I see with REITs, for instance, or even listed royalties platforms. We had studied it out that there's this equitization that happens where the correlations converge, the return profiles begin to look very similar, and so forth. And it's interesting that that behavior may exist as things are tokenized, but I would hope that the real value of the underlying assets would prevail in whatever form it is in terms of liquidity.
John, I think that gets to go ahead, Adam.
No, well, I was going to jump in real quickly and talk about, from my perspective and what I see looking out in the future, why this is so exciting. And it's a lot of things that we've talked about already, which is a combination of liquidity with good data to inform me of what the real value is. And I think where we're going to go with that, and this is coming from the perspective of when I had my RIA, back before 2022 is when I sold it. When we try to get clients, when we try to get anybody into any sort of alternative investment, which is what we're talking about here, be it private credit or real estate or something, the returns weren't there to justify getting in there, especially when you factor in the illiquidity there. Even though we talked about, clients want to get into something like private real estate or whatever, they didn't like the fact that they were giving up their money for a while. So we've addressed it with liquidity, and then we address it with good data. And I think that with other kind of pseudo macro factors that say now we have higher interest rates, now we're going to be able to get yield. Now maybe the stock market, we won't just get into index funds. You're going to have more and more people that are going to want to be in some sort of alternatives there, which again is what we're all talking about. And so to have liquidity plus the ability to look at all the data and understand what the price means, on top of, I think we go even further talking about baskets, talking about what things are worth it, and understand, Pat, that a particular real estate token that might invest in data centers versus a particular real estate token that might invest in, self-storage in the Southeast is going to be priced differently, but for whether it's you or whether it's me, right, going to buy it. So the beauty of it is I can look within the data, I can look at whatever else is in my portfolio and go, I'm underweight the Southeast or something. I'm underweight the Southeast US, or I'm underweight something like self-storage. I'm overweight data centers. And so it's going to give me the ability to price it the way it fits in my portfolio, not just here's what the market says it's worth. It's that particular token, X% of that particular token is worth more to me because it maybe balances out my portfolio better. And that all comes from liquidity and data.
It's the
Adam,
ability.
could I just add one thing to what Adam said? Because as I look at it, when we go to value something, just like when you go to price it as an investor, you're going to look for these incremental differences. I think one of the things that the valuation business hasn't done very well is identify those incrementals and put a number on it. We can start to do that now, as long as we start to realize that valuation is not the same thing as price discovery. Right? In other words, if I could supply a modeled price to Pat, who posted on Inveniam, without attributing me, then I'd be happy to start saying, what are the factors, what are the 4 determinant factors that are going to change that price week over week or day over day? And I can publish the sub factors as well. Then you as an investor get a lot more access to, all right, how do I pick the right piece for the diversification of my portfolio?
And the pooling, and Michael, I'm going to bring it back to you. The pooling, let's just say in a REIT, the liquidity that the critical mass needed in order to engage liquidity really does tend to be, it becomes a mashup, right, of all sorts of different assets that are not really like assets, because a cell tower, which is 13% of all REITs in the US, has long dated contracts. It's not sensitive to consumer behavior, but retail is. Yet you have in the same REIT, retail and cell towers, and the ability to articulate an economic thesis with some degree of specificity is just incredibly difficult unless we have the ability to buy and sell unique strategies to articulate our theses well. And Michael, that I think gets to Oasis Pro and what you're trying to do, right? A lot more smaller issues so that people can articulate economic theses extremely well. Is that a fair statement?
Absolutely, and I want to echo, what everyone have already said over here. I actually used to run the valuation at Greenwich Capital for the Race Group, and 100% agree, where valuation does not equal to executable price. And NAV, as we often say, within the private security space, is a monthly exercise. Sometimes, perhaps even longer in quarterly exercise. But the key part is that I think, what Julian just said before, having an AMM market allows for at least additional inputs into what the executable price may be. And in addition to that, we are starting to see the potential and the breakthrough, using tokenization. If you were to look into the recent news on BIDO, the BlackRock fund, alongside with Superstate, if you were to look into the kind of breakthrough feature, you have seen that, they allow for 24/7 liquidity, even though, obviously the underlying securities is very simple over there, which is a treasury T-bill. But because the valuation is easy to see for that particular product, now the additional features can be enabled because, such as, right, on the BIDO fund, you can deposit the fund token into a Circle smart contract. And on the Superstate side, they actually have built-in encumbering function within the smart contract to allow for anyone to basically use the underlying asset without selling directly, but without a valuation. T-bill is easy, it's par at 1. But anything else, including real estate, including fund structures, that may not have instant liquidity, requires a valuation. So that speaks to the needs and the importance of that.
And it is interesting, John. You were talking about with Julian that there is a reversion to a mean, or everything trades in a correlated fashion. And that might be because the predominant factor is not the unique asset at this point, because there's a paucity of tokenized assets. It is just tokenized real world asset. And that's the thing that defines it more so than the underlying asset. And that gets to, we need more assets to be listed. Does that make sense? So that we're beginning to do that. And that defining characteristic becomes less defining. But right now, Julian and what he's been putting up is trading at that premium. And Gabriel, I want to go to you. Thank you. You've been super patient. You guys at DigiShares, you're with your partners at Texture. You're going to be launching a real estate platform coming up. But talk to us a little bit about DigiShares' experience in this, and what does price discovery mean as related to the underlying value of the asset? And where do we think the markets are going to allow these things to trade? And how are we going to understand the different elements?
Yeah, I mean, we have a compliance first approach, of course. So, in the US, you need the ATS component. So we're very happy to partner with Texture Capital. They're a broker-dealer ATS based in New York. And we're going to be handling the whole UI, UX, smart contract technology part of things. And we're integrating to their API, and they handle the compliance back end. And yeah, we've been quite active in the real estate space for the past 3-4 years, speaking with a lot of developers. And they always speak of a massive illiquidity discount, 30-40%. And for many of them, liquidity is the biggest benefit. And so we just want to provide a solution in the US that's very simple, easy to use, digitally native, and yeah, competitive in terms of cost. So that's why we're doing this. And yeah, and it's not just speaking to real estate people that you can see that there's an illiquidity discount. It's if you look at the academic studies over the past decades, it's very clear. You have two types of studies: the pre-IPO studies that look at what's the difference in valuation between a private stock a few months or years before the IPO, and the difference between right after, like at the moment of the IPO and right after. And then there's the restricted stock studies that look at the difference between a publicly traded share and then a share representing the equity in the same company, but that's restricted. Sometimes companies do that to save money on the offering, on the legal side and compliance side. Yeah, and in both cases, if you look at pre-IPO, like the most recent data looking at difference between between 0 and 3 months before the IPO, well, you're going to see a 19% discount, and for the restricted stock studies, the most recent ones, again, you see around a 20% discount. So we're really excited to provide the infrastructure that will slowly help solve this problem. Obviously, it's not because you provide the infrastructure that magically it's going to be zero or even multiples. Like Julian was saying, there's a bit of work on the ecosystems part to bring demand to these secondary trading venues. But yeah, we're excited to be on this journey.
Gabriel, thanks so much. And we're going to I appreciate everybody's fulsome comments, and we're going to try and do a little bit more rapid fire approach so that we're getting a dialogue going. And Albert, I really, if you could kind of maybe help tee this up. Last podcast, you gave maybe one of my new favorite analogies, that you don't need airbags on a buggy, but you do on a Ferrari, right? And the reality is AI is going to process data at scale and speed that we are not used to in private markets. And with that, we're going to start to see data moving and valuations moving, and these pairings, we're going to see trading like we didn't used to. And in what ways is AI going to speed it up? And then what are the tools we need to add as the airbags, do you know what I mean, to prevent hallucination, et cetera? But what do we need to do as we're going to really start to see the cycle times pick up?
Yeah, so a lot to say there. Pat, you have a gift for asking questions that could be books or entire podcast episodes on their own. And I'll try to get straight to the point. There's a lot of really exciting capabilities that AI continue to have. But enterprise really isn't starting to integrate their main core operations with it yet. And that's for a bunch of reasons, one of which, in this particular case, involves one of the shortcomings of current AI infrastructure. So AI is very good when it's answering questions about things that don't change very much. And the truth is that the world overall does not change very much from one day to the next. But there are certain things that do change very quickly, and sometimes the most recent information kind of invalidates all the old stuff. So imagine that you're sitting there in late October of 1929, and you've trained your AI, if it existed, on 100 years of stock market trading data, and you're feeling good, everything's great, you got the model nailed down. All of a sudden, the stock market crashes, whole world's different, and you have a model that is outdated instantly. What do you do? And that's kind of the problem. When you have data sets, such as in a financial transaction or financial markets, that are both large and dynamic, all of a sudden you need a fundamentally different system and infrastructure for feeding in the data that the AI uses to compute in the first place. That's one of the main challenges that we've been working on in Inveniam for months, which is how do you make sure that the decision maker, the processor, whether it's a person or an AI model, has the correct, most up-to-date, verifiably true, most recent golden copy data so that it has the right underlying information to make decisions.
Yeah, and it's instead of, hey, let's let AI power your process better, it's the AI process is better than your process. And right now, the bright, shiny AI sales pitches, our AI is better than your process. And people go, I don't know that I buy that. When AI can be matched to improve your process, that's when it starts taking off everywhere all at once. And this is kind of what we're talking about. And I want to talk about when genius failed, right? Everybody should read that book, right? Long-term capital. And they had traders, right? And they had all the guys who were brilliant modelers, and they were levering the heck out of the markets, right? 100-to-1 leverage. Their models were fully informed, but they had traders as a ballast so that the quants didn't run out ahead of themselves. Well, the models kept winning and winning and winning, and the traders got more and more discredited. And I forget what it was, 4 months before, 6 months before long-term capital crashed, they moved all the traders onto a different floor because all the quants were just tired of hearing about them, that the market might not work. You know what I mean? They just said, hey, we don't need the guardrails anymore. We don't need you. And they just moved all the traders off the floor, right? Some the main ones stayed, but some of them quit. And I think, Kevin, what is the data where the right people are feeding the right data into the markets so that the markets can perform, right? And what are those data elements? And that's not static, that is changing, right? Hey, this is coming about. Talk to us a little bit about that.
It's something that I worry about all the time. What is that right signal, and where does it come from to give traders the confidence to make that, that they've understood the last trade and that they can make the next trade. And I'd kind of like to, there's that. And sort of in our solution, there are two sides to that, which is there's got to be this signal about price, or something similar enough to price that people can trade on it. And then the other question that I have is who is that liquidity provider? Who is that one who's able to act on that signal? Is it the general partner? Is it a hedge fund? Is it retail investors? What are I'd like our panel to talk about either side of that they're comfortable talking about. Either what is that right signal, and how do we push it out there, and then who has ears to hear and cash to act on that when it comes.
So, Kevin, I think that I'm familiar with at least one side of your question, and maybe a little about both. But the first side is that there is a huge world of aggressive liquidity providers. We call them hedge funds, and they would love to move the market, or they would love to take the difference from sort of a -20 discount to a +10 premium without taking asset risk. I mean, that's the critical part here. If all they're getting paid for is the compression of that liquidity premium without asset risk, you'll have piles of liquidity. It's going to take mechanisms, it's going to take information, but I'm not worried that the liquidity providers won't show up. I think what will happen instead is that the GPs, who are then going to realize that they've lost this massive difference, are going to either fight back or start hedge funds. One or the other. They're going to look for the same thing. But I think that the capital will be there to provide liquidity, because that's a a time-honored way of making money, providing liquidity without taking asset risk.
And David, I think that when we talk about institutions and big asset managers versus hedge funds versus in this world and this day and age, many family offices and the whole GameStop world. Do you know what I mean? The apes that really want to trade and add a level of truth telling into the markets that the hedge funds many times get too connected, right? And I remember I was at this conference, I talked about it a couple times, and our friends, one of the big banks, we're talking about DeFi and TradFi, and the one of the big banks who was at this roundtable of CTOs that McKinsey was hosting, and they said, I want you to know when you say TradFi, we take that offensively. And the representative from Coinbase said, well, we intend it that way. And which was maybe the best line of the whole day-long session, right? And the point was, we're bringing in a new level of utilizers. And I'm going to say John Nieman and who he represents, and it is a market entrant who's giving money to TradFi, giving money to hedge funds, but also is powering these other new market players who are acting on better data, that is powering things that Julian Kwan is building today, right? And B-REIT is a great example, right? There was the big article that came out 2 days ago, right, saying that all their underlying information is wrong. And when they post a price, that's the wrong price, that everybody runs for the door. Do we need a new mechanism to provide price discovery beyond just the market price, but a performance validator? And Matthew Melke posted a great question on LinkedIn. If everybody in this side can look at that question, I would love anybody to do it. But Inveniam, this is the whole point. We're not seeking to aggregate the data in the center, but the new technology is available. We can surveil the underlying asset real time. Real-time surveillance of an underlying asset was not even a possibility 2 years ago, 4 years ago. Right? When Inveniam set out 7 years, we were talking about future state. It is possible today for real-time performance. That data, you don't need a data aggregator in the middle, and conceiving of it that way, you will die. And what I'd like to do is just host this up. There's a number of great questions that are in here.
I think you guys brought up, date, like what is the right data? And that goes a little bit, I think, to Matthew's question. And I think what we're going to find out is the right data is different for everybody, because the beauty here is because we're going to have so much information and liquidity that everyone's going to be able to price. And I understand that my personal valuation does not equal price discovery, but I'm going to determine what I'm willing to pay for something or what I'm willing to sell an asset for. And then
if you have good underlying data on that.
Exactly. I have to have the good underlying data. But again, I think once we figure out how much data we can get and have it in real time, then we're going to want more and more and more. And it's going to be different for different people. So just if I take Matthew's example here, valuation of a building includes energy performance, work achievement status, preventative maintenance costs. You might go even further down a rabbit hole and go, well, if this building is in Miami, Florida, what is happening to maintenance costs in Florida versus what's happening to maintenance costs in Omaha? And I'm going to be able to get even deeper and deeper and deeper, because I go, well, I didn't usually have this data up to the minute before. Now I do. And now I have to go this much farther to figure out how much it's worth to me versus how much it's worth to John and David. So I think the beauty here is once we start getting good, verifiable data, which we talk about, then we're going to want more. And again, it's going to be different for different people, because once I have all that, I can price it for myself. And part of that might be, going back to my example, I might have ideas about using something like AI to go, well, here's what I think is going to happen to real estate in Miami based on all these models I have, macro factors, micro factors. I'm looking at how many people are moving there. I'm looking at business startups, all these other things to determine my valuation for real estate in Miami based on really good data. And I think that's exciting. And going back to what John was talking about earlier with music royalties, that might be my favorite, most exciting new asset class that's going to come out, because no one ever had really the ability to invest in music royalties. And I think you're going to get experts now that they're going to be experts in what, in types of music that are going to be hot. And they're going to use AI to look across Twitter and TikTok and Instagram and figure out who's going to be the next hot thing and then price it for you. I think that is incredibly exciting.
Yeah, and I'm going to use this. I want to tee this up to John. When we have an army, a fully distributed army who is using these tools to parse data in order to find alpha, right now, CPP, as one of the biggest pension funds in the world, they re-engineer with all sorts of data signals where they believe consumer behavior is going to come out, and they try and spoof what all the reporters are, come up with their own thesis and trade ahead of it. Pat O'Meara has no ability to do that. CPP can do that. Do you know what I mean? But the reality is, using tools that John and others are creating, it is going to democratize the access to that type of capital or that type of intelligence. John, can I see you on that?
No, that's absolutely right, and that's eventually where it's headed. And then my question, then, I guess, is, and it's more philosophical. It's yet to be seen. How will the market vis-a-vis value react? We've seen it with anything that's listed on the stock exchanges are traded like equities, and that was my point earlier. Is that the correlations of real estate start at around 0.3 to other similar, say, equities. As soon as it's listed as a REIT, it goes to 0.6, 0.7. So it begins to look very much like equity. And part of that is indexation, and part of that because the market just says, okay, I don't want to pick, I just want to invest in everything. And so you have this wholesale behavior, and then there's emotions mixed in, fear, greed. So the question is, what signal, and it goes back to someone made the comment earlier, is what signal is it that AI is learning from and picking up on? Is it the behavioral finance part of it, or is it the fundamental true value analysis that we would all love to see, I believe, here on this call? But however, if it gets systematically traded, such as the public markets have for the last 30 years, in doing exactly the same thing, taking signals and trading on that information on micro levels. If that ends up being done because now it's more available, then how does that help in terms of really, for those that really want to transact at the pure true value? And then there's the argument, okay, value is whatever anyone's willing to pay for it. So there's that. But we all know what I mean when I say that there's the transactable value, there's a transaction value, and then there's the real appraisal that's done on the individual asset based on the revenue profiles, the management team, whatever. So that's my take on it. However, by and large, democratization, fractionalization, the increased frequency of reliable data around assets from as diverse as aircraft to music royalties to houses. I think that's an amazing leap forward, and I'm excited to be a part of that. And that's what I'm seeing. But I still have these philosophical questions that I don't know if anyone has an answer for them yet.
I think people have viewpoints. The market will tell us the answer, right?
Yeah.
And Julian, I want to kind of throw this next one to you, right? Yesterday, I was sitting with a very large family office, real estate generated wealth by the creator of the wealth, who's been an investor in crypto. They've been an investor in tokenization. Yet they're doing, they're in the market 3, 4, 5 times a year doing financings. They're going into the market for $100 million. And and we were saying the DeFi ready market is ready for you to put that bid in and go. And even though in the market, they just said, oh, I know, but this is a real building and we don't want it to fail. So we're just going to go this traditional route. And we're not even going to dip our toe in to see if we can get $100 million bid from Maker or, go to Arbitrum or some other mechanism to seek that liquidity, right? And the interesting thing is there's an intellectual exercise, but the change of behavior when it is critical to their continued operations, they go traditional routes, right? And that dissonance in my own mind at the meeting, I was like, guys, you were investors in this. Go seek that 100 million here right now. And they're like, nah, we're gonna go, fill in the traditional name here. Julian, what's it gonna take to get the institutional coming your way where they're seeking that as a core viable mechanism for liquidity in their real world assets? What's it gonna take?
Yeah, I mean, it's already happening. There's been a couple of pretty intense kind of white papers written by UBS and JP Morgan on AMM models marrying with TradFi, and then data research driven kind of analysis of what this can do, and the savings and the benefits and the discounts across all these kinds of trading. So I think it's very much at the forefront of the thinking. I mean, if you are looking at the cryptocurrency market, again, most people think that, there's a million things to say about it, but most people think that, when you look at the volumes of trading now, a lot of the deepest the deepest pools are on the decentralized exchanges, which have these crowdsourced AMM liquidity pools. So, I mean, it's proven itself, right? And then when you think about, I think I try to look at it a little bit more simple. I mean, today we've talked a lot about GP, LPs, and funds and all this. It's a lot easier to think about this stuff when you do a startup, because you can put a startup up and what's the value of a startup. No matter where a startup trades, NASDAQ or anywhere, it's always made up, right? When you seed round and all this. So it's a lot easier to do a sort of a startup, and then price discovery is what everyone sort of wants to pay for it. But at the end of the day, I think the beauty of the AMM model, which is the core of our kind of daily work, it allows the beginning of liquidity. It's the start of the liquidity. So if we're getting valuation and all the kind of more sophisticated parts that I guess some of the other speakers have talked about today, when people come to me and everyone says, I want to do a tokenization of a real estate fund, institutional or a house or whatever, everyone thinks they've got the best asset in the world. Everyone thinks that someone wants to buy it. And everyone thinks there's this unicorn magical market maker living out in somewhere waiting to market make their asset that they haven't even tokenized yet. And they've never even spoken to them. Every single company does it. I've had like 5,000 of these discussions. So the answer now is, well, we do have an answer for your where's the liquidity? It's you. And then everyone sort of goes, what do you mean it's me? Go cross-eyed and have a bit of a sort of a brain fart. But it's like, you can come with X amount of your equity tokens and X amount of your USDT or whatever you want to pair it with, and you can start the liquidity pool first on this AMM. What's the liquidity? It's up to you. What's the valuation? Up to the market. Why would I do that? Because no one else can do it. There is no other solution. There's no one else who's ever going to do your lemonade stand equity or your house token or whatever it is. So here's a solution that kicks it off. And then what we've seen in crypto is that those prices, then the price discovered, everything, it's been made by the market, right? And most of these crypto assets have got, brackets, no intrinsic value. And some of them are trading at billions of dollars because people can access them. So I think that most of, I think you said it before, and there's been some great comments tonight, most of we don't really have to worry so much about the end game. It makes the market makes itself. It's a matter of like putting these assets into this system and letting it roll. And just to try to get back to your question, we've got banks saying, can we white label IXSwap now for our own assets and get it there? So I think they're already here, and people are. I think I can see what it has done for type of asset, and maybe it won't do that for all, like as in crypto. Maybe it won't do it for every type of real world asset, but it's a proven model, I would say. And now it's about exploration and everyone throwing assets in and trying to get started, and then maybe answering a lot of the questions that we've been talking about today.
Julian, the only thing I'm going to say is I'm going to push back on proven model. It's a proven control case, right? And what we need to do is see how it scales, right? Because what you've done is launch it and it's working. You know what I mean? Now we need
So what I meant is, what I meant was it's a proven model. It was a proven model for cryptocurrency, and now we've got to work out. Now we're going to work out real estate tokens and funds and startups and everything. Everyone's going to work out what works. I don't know the answer yet.
Yeah, I think the biggest difference is that in the AMM model, even though people call it a model, but in reality, what's happening is that rather than being a central limit order book, for example, that we are very familiar with, the AMM model actually says and have to behave if the liquidity is there. If the liquidity, meaning like the cash and the asset side are not there, the model actually would change the price in itself. So I think what is very interesting is that AMM model effectively tells you that the moment you take one single asset out from the other side, the price will change, and for that reason, you have a price discovery. I think obviously it's a long game, especially here in the U.S. But when the regulations is ready, especially surrounding the custody side, the equation surrounding the smart contract, I think it's an exciting technology.
Adam, give us your final word, brother. We got 5 minutes left. We're going to go speed round.
Okay. I think my final word is what we've talked about here is trying to understand what data needs to go. How do we verify and validate that data? And under all of us understanding that what we know about valuation and what we know about price discovery is going to change because we're going to have more data. We're going to have it up to the minute. We're going to have AI helping to evaluate, as I think, as someone questioned or said, AI is going to be the one negotiating. I think we're going to have to, at some point, not throw away, but augment what we know about valuation and price discovery, because when you have this amount of liquidity, this amount of data, and this number of people that can now participate in the economy, you have to say, okay, everything I've learned doesn't necessarily fit. It fits a little bit, but you can't say this is how we valued it 15 years ago, because we just have more information and more participants.
It was Bob Guzman who's commented again on this. Gabriel, give us your thoughts, brother.
Yeah, so I always love looking at the accounting rules. I feel like a lot of the problems in the financial system can if you want to look at the source, a lot of times it's sort of accounting rules. And in this case, I think looking at IFRS 13 and the valuation of assets, the way it's done, this could really push more institutions to participate. And what I mean by that is that the lowest level of liquidity, level 3 right now, means that you have a lot of cash requirements, audit requirements, and if your asset, if like a real estate asset is trading on a venue, whether it's Julian's IX swap or Oasis or realestate.exchange starting in Q3, then you could move that up to level 2, which means there's an actual price, and so you reduce the amount of cash on hand that you need to have and the audit requirements. So that can, it's always interesting to look at the accounting rules as well.
Wonderful. Hey, Bob, David, give us your thoughts.
So I have two. One is Gabriel's absolutely right. Valuation policy isn't built for the conditions that Adam talked about. This current real world, lots of data, high. It's just it's getting increasingly wrong every time I look in the digital asset space, and that is what I'm responsible for doing in our valuation practice. So valuation policy is wrong. It's got to change. And along with that, I think that if everyone wants to call me up and start a hedge fund that is going to arbitrage out illiquidity, I'm happy to join.
All right, John and I will call you later this afternoon. And Albert, any final comments from you, brother?
Yeah, just one brief one. I think as we start looking towards AI supporting the price discovery of private market assets, we have to consider that your counterparty is going to have an AI too, and there's going to need to be an environment for those interactions to take place that keeps that process under control. This is exactly what we are working on and building every day at Inveniam. Pretty exciting.
Kevin, thank you, Albert.
Just to keep on the AI theme, there are these battles between the AI that makes up the data and the AI that detects fake data. We've had a little bit of a conversation on on the LinkedIn chat about how will you trust the price and the data behind it. And part of my answer is, well, look, it's actually hard to fake toilet flushes and key fob entries and energy use that serve to validate the things that the appraisers are looking at, which is, occupancy, rent roll, and intent to renew. But we're going to get to where an AI will be able to fake a building full of people and the toilet flushes that would correspond to that. And so the provenance of the data is going to be sort of more important than that world. And that's a point that Albert makes all the time, which is if you ask the AI to see its footnotes, or if the AI knows it's going to be asked, you'll get better answers.
If the greatest book written, if it has no footnotes, is still fiction. And the reality is we gotta provide those. Boy, it's been a pleasure to be with all of you. It is challenging when we have 9 of us, but we really did want to have this broad cross section with Oasis Pro and DigiShares and what they're doing. Julian, you as just continuing to be a leader in here, and thanks for giving us your representation. John, we're lucky and blessed to have you here. David, we're excited to kick off this hedge fund. And then Adam, we really appreciate your insight as well.
Thanks, Pat. Appreciate it.
Thanks, Pat. Nice to meet everyone.
Thank you, Pat.
Thank you, Pat.
Bye, guys.
Take care.